Are you ready to dive into the fundamentals of economics and accounting? This video will guide you through key concepts essential for understanding financial accounting. Discover how these principles apply to real-world business scenarios. In financial accounting, recording transactions accurately is crucial. The double entry system ensures balance by recording each transaction in two accounts. For instance, buying equipment for cash involves a debit to assets and a credit to cash. This method maintains the accounting equation: assets equal liabilities plus equity. It's the backbone of accurate financial reporting. Log into your account. Financial statements are vital for assessing a business's health. The income statement shows profitability over time by detailing revenues and expenses. The balance sheet provides a snapshot of assets and liabilities. Meanwhile, the cash flow statement indicates liquidity through cash inflows and outflows. Regularly preparing these statements informs stakeholders. Accounting principles ensure consistency and accuracy in financial reporting. The accrual principle records revenues and expenses when they occur. The matching principle aligns expenses with related revenues. Historical cost principle records assets at purchase cost. These principles make financial statements reliable. They help businesses make informed decisions. Financial ratios offer insights into a business's performance. Profitability ratios assess the ability to generate profit. Liquidity ratios evaluate the capacity to meet short-term obligations. Leverage ratios indicate financial risk by comparing debt and equity. Efficiency ratios show how well assets are used. Ratio analysis supports strategic decision-making. Budgeting and forecasting are key for resource management. Budgets outline expected revenues and expenses, guiding spending. Forecasting predicts future financial performance using historical data. Businesses use these tools to plan for various scenarios. Variance analysis compares actual performance to the budget. This process helps in making necessary adjustments. Log into your account. Depreciation spreads the cost of tangible assets over their useful life. Amortization applies to intangible assets like patents. Methods like straight-line depreciation allocate equal expenses each period. These concepts affect asset value and tax liabilities. They provide a clearer picture of financial health by accounting for asset usage. This is the topic of this scene. Inventory valuation impacts profit and taxes. FIFO assumes first items bought are first sold, affecting profit and inflation. LIFO assumes last items bought are first sold, showing lower profits. Weighted average cost averages inventory costs. Choosing the right method influences financial outcomes. Each method reflects different business strategies. Cost control ensures expenses stay within budget for profitability. Break-even analysis determines sales needed to cover costs. It calculates the point where total revenue equals total costs. This analysis aids in pricing and investment decisions. Understanding these concepts helps businesses maintain financial stability. Auditing verifies the accuracy of financial statements. Internal audits evaluate internal controls to prevent fraud. External audits ensure compliance with standards like GAAP. Compliance involves adhering to legal and regulatory requirements. These practices build trust and credibility with stakeholders. The double entry system records transactions in two parts. For example, investing cash into a business increases both cash and equity. Buying equipment decreases cash but increases assets. Sales on credit increase accounts receivable and revenue. Paying rent decreases cash and increases expenses. This system ensures balanced accounts. Log into your account. Balancing accounts confirms the accuracy of financial records. It involves ensuring debits and credits match. For instance, a business records all cash inflows and outflows. The final balance reflects accurate financial standing. This process is vital for preparing financial statements. A trial balance lists all accounts with their debit and credit balances. It ensures total debits equal total credits. Discrepancies indicate errors in the accounting records. Correcting these ensures accurate financial statements. A balanced trial balance is crucial before finalizing reports. Period-end adjustments align financial statements with the accrual basis. Prepaid expenses are adjusted to reflect usage. Accrued expenses are recorded when incurred, not paid. Depreciation is calculated for tangible assets. Unearned revenue is recognized as services are provided. These adjustments ensure accurate reporting. Interpreting financial statements involves analyzing key metrics. More information about it in case you need to add any details. Profitability ratios like gross profit margin indicate efficiency. Liquidity ratios show the ability to cover short-term liabilities. Solvency ratios assess the capacity to meet long-term obligations. These insights help stakeholders understand financial health. They guide strategic decisions. Producing financial statements involves summarizing financial data. An income statement details revenues and expenses. A balance sheet lists assets and liabilities. These documents provide insights into a company's financial position. They are essential for stakeholders to make informed decisions. Accurate statements reflect a business's performance. Consider a business transaction using the double entry system. An owner invests cash, increasing both cash and equity. Buying equipment reduces cash but increases assets. Sales on credit boost accounts receivable and revenue. Paying rent decreases cash and increases expenses. Each transaction maintains the accounting equation balance. Balancing accounts involves matching debits and credits. For example, a business records cash inflows and outflows. The final balance should reflect all transactions accurately. This ensures financial records are correct. It's essential for preparing reliable financial statements. A trial balance checks that total debits equal total credits. List all accounts with their balances. Discrepancies highlight errors needing correction. Correcting ensures accurate financial statements. A balanced trial balance is key before finalizing reports. Period-end adjustments ensure accurate financial reporting. Prepaid expenses are adjusted for usage. Accrued expenses are recorded when incurred. Depreciation spreads asset cost over its life. Unearned revenue is recognized as earned. These adjustments align with the accrual basis of accounting. Analyzing financial statements reveals business health. Profitability ratios show efficiency in generating profit. Liquidity ratios indicate the ability to meet short-term debts. Solvency ratios assess long-term financial stability. These insights guide strategic planning. They help stakeholders make informed decisions. In conclusion, mastering financial accounting concepts allows you to produce accurate financial statements and ensure compliance. These principles support informed decision-making, promote financial stability, and are essential for achieving long-term business success. If you have any questions, please feel free to reach out via WhatsApp or email. Thank you.